Coming up in today's show, stocks finish a little higher as CPI data comes in a little lower. I'll take a look at whether that means the Fed is done or not. The other big risk factor for stocks, Russia's economy continues to dive and gas prices spike in Europe. Welcome back to the Click Capital Daily Market Show, everybody. And in line with much of this year in CPI days being a non-event, that was pretty much the same deal again here today. Headline inflation came in at 3.2%, which is the second consecutive month with a little uptick in inflation. However, it was a little bit below what analysts expected at 3.3%. And once again, another muted response from the market. We did finish up slightly higher in the S&P 500 and NASDAQ, helped mostly by the mega cap techs. However, overall, there was a bit of bearish breadth out there, and mid caps and small caps actually finished a little bit lower. And so just looking at the 15-minute chart of the S&P 500 here, the market initially liked that lower than expected inflation data. We gapped up to 44.92, got a bit above 45.20 early in the session, then reversed course in mid-morning and finished down near the lows. And just looking at the daily chart here, did put in a bit of a shooting star formation on the S&P 500 and put in the second consecutive close below the 50-day VWAP. Same deal on the NASDAQ, but we've still got the Dow Jones, mid-caps, and the Russell 2000 slightly above their 50 days. So the big one today was the July CPI report. Showed the consumer price index rose 3.2% from a year ago in July, slightly below expectations of 3.3%. And we had core CPI coming at the 12-month rate of 4.7%, also a little bit below expectations. Almost all of the monthly inflation increase came from shelter costs, which were up 7.7% from a year ago. And real wages adjusted for inflation were only up 1.1% a year ago. So whilst that's still good progress on inflation, it's still too early for the Fed to declare mission accomplished, as the rate is still well above their 2% annual target. And we've still got high inflation in things like shelter and food. Energy starting to tick back up. But on the other side of the coin, there's been things like used car prices have come down a lot, and other things like electronics and appliances as well. We also had initial jobless claims come out today, a little bit higher than expected, 248,000 claims versus 230,000. And there's the core inflation rate, 4.7, a little bit below 4.8 that we're expecting. Then tomorrow we've got some GDP numbers coming out from Great Britain, inflation data out of France, and then some PPIs from the States. And so with that little bit softer CPI print today, Fed Fund futures market decreased the probabilities the Fed will hike in September to 9.5%. So the market's kind of saying the Fed's either close to done or they could stay in this staggered hiking cycle where they pause for one and hike for one, like they've done recently. And so the odds as they stand now is they'll probably pause next month, but there's still better than a 1 in 4 chance they could hike in November. And that'll depend a lot on the September and October CPI reports and jobs data as well. And of course, influenced by any unknown events and surprises the market may get before then. But as it stands now, the market is still pricing in a Fed funds rate 125 basis points lower than where we are now by the end of next year, implying a high likelihood that we could see the recession at some point in the middle of next year. So I guess we'll just have to wait and see if inflation does indeed keep ticking down towards 2%. Then the Fed can definitely pump the brakes and back off and maybe start decreasing rates next year. However, if inflation is stubborn as some suggest, like this economist here, Jim O'Neill, says interest rates should stay around 5% for longer. Because he said, in order to deal with the challenge of core inflation coming down and with the whole overhang of all the stimulus that's accumulated over the past decade, plus I think that's right. The other big risk for the stock market is the Fed reversing its QE, quantitative easing, trend over the past decade and a half of printing money and buying lots of different securities out there and artificially pumping liquidity in the system. Over the last year or so, they've done the opposite of that, QT, quantitative tightening, and they've reduced their balance sheet by $900 billion over the past year and showing no signs of stopping. So this liquidity drain is definitely a headwind for the stock market, and doesn't mean the stock market can't keep going up, but it could put a bit of a lid on its gains because the more risk there is in the markets, the more opportunity there is for the Fed to keep decreasing their balance sheet, which currently stands at 7.6 trillion and a bit off their almost 9 trillion peak. However, what the market also really knows is if things ever get bad, the Fed will have no hesitation at expanding that balance sheet right back up in a moment's notice. So there are a lot of strong indications at the start of the year we may get a recession a bit later this year. However, as we've seen, the jobs market's held up pretty good, and some of the weakness we've seen in Europe and China hasn't spilled over to the States. And so the stock market's had a pretty good rally the last couple of months, on top of the decrease in inflation data. However, according to this analyst, the no recession relief rally is over, and he says to expect flat markets for the rest of the year. He also said we see signs of a recession, however mild, is likely in first quarter 24. He mentioned the lagged effects of past policy tightening, risk of moderate oil shocks, and calls the old inflation ceiling the now new inflation floor. Another news out today, Russia's economy, much like China's, is continuing to tank harder than the rest of the world, with their current account surplus dropping 85% from January to July compared to the same period last year. This is largely because of their energy revenues, which are down 41% year over year for the first 7 months of 2023. And so far, their strategy of largely relying on China to finance them and prop them up isn't working as great as they have hoped, and doesn't appear to be working too great for China either. Already seen deflation in their economy, and with their exports dropping off a cliff as well, and record high unemployment amongst their young. And the Eurozone, which is already largely in a stagflation environment, are going to be paying a lot more for their energy as they go into the cooler months, with gas prices jumping 40% on the back of fears of major strikes at LNG plants across Australia. And Europe's also still in the transition, structurally changing its reliance off Russia for energy, and that process is likely to take a few more years as well. Fear and greed index is still elevated at 68. Another busy day on the options market, 43.3 million contracts traded, 54% of them calls. Dark pool traders still not showing a lot of interest in this market, and another uptick in corporate insiders selling stock and still not much interest in buying. Another low volatility day across the board out there. International stock indices all pretty much finishing flat. VIX pretty much finished flat as well, just under 16. And it looks like we're getting a bit more continued hedging going on out there, with the equity plus indices put call ratio today finishing at 106, and it's been climbing up a little bit in the equity only as well. Still weak short-term breadth, with 35% of stocks above their 20-day average. And once again, the amount of stocks making new lows on the Nasdaq eclipses the amount of stocks making new highs. Growth versus defensive sector spread just kind of holding below its 50-day VWAP. And another good day for credit spreads, with junk bonds breaking out to new multi-month highs versus investment grade debt. Still got the government bond 10-year yield in a short-term uptrend above 4.10. And with that move high on the back end of the curve today, we saw TLT come off a bit hard, down 1.6%, and high yield bonds still holding up a lot better. Dollar index sold off in the morning but was dip bought and holds just above 102, and Bitcoin still consolidating above 29,000 a coin. Overall, commodities were pretty flat today as well, and pretty mixed across stock sectors. More weakness in the meme space. Clean energy stocks was the loser today, down over 2%, and the winning sector was biotech, up 0.86%. The defensive sectors rallied up in the morning, but they too were sold off going into the afternoon session. And energy stocks continue to trade well, with ExxonMobil breaking out to multi-month highs. Apple's still looking a little weak and consolidating here. Same with Microsoft in a short-term downtrend. But Google and Amazon continue to hold up pretty good. NVDA closed below its 50-day VWAP for the second time today. Little bump up in Tesla, but still on a short-term downtrend. And meme stocks mostly continue their pullback as well. Let's look at Disney after we got their earnings yesterday. They increased their prices for all their streaming content by 30% across the board, even though they're losing subscribers. Did deliver a slight beat on EPS, and we just had news of ESPN doing a $2 billion licensing deal with Penn Entertainment to create the sports betting app ESPN Bets, and the market appeared to like all of that, finishing the day almost up 5%. And other than that, it was a pretty flat, non-eventful day, which has been typical this year on CPI days. And we can still see that in the VIX, which is trading pretty flat, and hasn't been since Silicon Valley Bank went under back in mid-March that it's closed above 20. However, we are in a seasonally weak period in the stock market, normally accompanied by spikes in the VIX as well. However, it doesn't look to be any concerns over the economy or inflation or jobs data that looks like it's going to cause a spike anytime soon. So it's probably going to be some other external surprise shock that could do it, as Q2 earnings season's been holding up a bit better than expected as well. But technically speaking, we are in a short-term pullback in the market. Most sectors underneath their 5 and 20-day moving averages, and about half of them below their 50 days. And we've got mega cap techs like Apple, Tesla, NVIDIA, Microsoft all below their 50 days as well. So we'll just have to see whether we get more profit taking and it just turns into nothing but a technical correction, and possibly whether we see that uptick in the CPI next month or October that could also upset the stock market. But as it stands, it looks like the stock market's in for a quiet, sleepy summer, but as usual, it doesn't last forever, and something will eventually wake it up. That's it for this Thursday. Thanks very much for tuning in with me, and we'll see you again tomorrow afternoon. Cheers.